Well, Emira Property Fund has released its full-year numbers today, which showed increased expenses, decreased headline earnings, but an increase in properties as some of its joint ventures began to bear fruit. The company has also lowered its full-year dividend. It still maintains that it's doing well given the depressed environment, though. And CEO Jeff Jennett joins me in studio now. Thanks so much, Jeff, for your time today. So you talk about the tough operating environment worsening, but Emira on a better footing to withstand that from here on out. What impact has the tough economy had, and how have you now maneuvered?
Yeah. Thanks, Alicia. The market is certainly much more tougher than it has been. We took the unusual steps 12 months ago of telling the market that we were expecting a drop in distributions. We did achieve our targets exactly, where we came in at the -2%. And as much as the environment has been tougher, we have made some significant headway. First and foremost, on our vacancy side, we reduced our vacancies from 7% in December down to 5.7%. We've made some meaningful progress on our asset disposal side, where we disposed of 11 properties in this 12-month period at a premium to book value, which is then very informative in terms of the way the value of the 134 remaining properties are valued. So we've certainly taken some steps on that side. We've also launched some what we call the intelligent relocation program, which helps and is an advantage for our tenants, where roughly on a 5-year lease, if you sign up a 5-year lease with us on certain selected buildings, you'll get rental benefits equivalent to 14 months out of your 5-year rental. And
that must work to your favor in a very big way, because one only assumes that in this tougher environment where you've improved vacancies, as you say, from 7% to 5.7%, you've renewed 77% of your expiring space as well, those rental negotiations have got to have become a lot more tough.
They certainly have, and this is why we're having to provide these sorts of benefits like our intelligent relocation program. We've also had to we've provided a broker app which enables our brokers, who do the majority of our leasing, just makes it easier for them to do business with us. So there have been a lot of initiatives on that side, and this is what's so important in this year, is that we're laying the groundwork so that we will be able to deliver positive growth in distributions from this year going forward.
While that application, for example, comes with cost benefits, are you having to compromise quite extensively on your lease terms and rental escalations to fill vacancies to retain tenants?
We do need to. Our tenant retention ratio is still sitting at a high 77%, but we've been forced to provide these incentives, like our tenant intelligent relocation. We're needing to do this. The tenant has got more power, and in this environment, there's certainly some very attractive options for tenants.
Okay, you've also touched on letting go of your non-core assets or rebalancing of your portfolio, but you've got office, retail, and industrial exposure. Office exposure down a bit, sitting now at 41%. Retail up a bit at 44%. Are you happy with the kind of exposure you're sitting with right now in the current South African environment, given the fact that your exposure is primarily domestic?
So we are taking further steps to reduce our office portfolio. We've identified a further 16 assets, totaling just north of 1.1 billion rand, and those we would look to dispose of in the next 12 to 18 months. So that will certainly bring that 41% office exposure down into the 30s, and in my mind, that's a good mix for a balanced and diversified fund.
How much exposure are you targeting towards residential? Because I picked up that you are going to be partnering with real estate investors and Feenstra Group for the residential conversion of the former Sasol offices into residential units, and that within the Rosebank area. There's a lot of supply hitting the markets within that territory. What demand are you actually catering to?
So that one's a particularly exciting one, because what we're doing there is we're not feeding this commercial supply that's there in Rosebank and that more of it is coming. We're actually addressing this differently by taking out some office out of that market and converting that to residential. Now that development, which is focused on LSM 7 to 8, will be a 280 bed unit development, and it will then be provide accommodation for those office workers that are there. So it's very important to recognize where the growth is in the market, and we don't want to be competing on the commercial office space, rather supply the residential side. And our joint venture with the Feenstra Group is a good one. It's Emira's method of testing the water.
Yeah. Are you not bordering oversupply, given all that activity that is starting to prop up on the residential space in that territory? Because of course that will impact rentals down the line.
Definitely not in the Rosebank space side, and definitely not with the product that we're providing.
Okay, we didn't even get into your international exposure. It now stands at around just 6% off a balance sheet, but we'll have to rope you back into studio at a later stage, taking a look at how you're looking to extend that from here on out. Jeff, let's leave it there. Thanks so much for having joined us in studio today. Of course, CEO of Emira Property Fund, Jeff Jennett. We're heading into a short break.